Hello everybody and welcome to today's video. So today I want to talk about Coinbase, mostly because they reported their earnings yesterday, and the earnings of Coinbase, they're going to do what they're going to do. It's a beat compared to what the analysts were saying, but it doesn't change the fact that Coinbase is kind of in turmoil right now because the Bitcoin and crypto market is down, and it's down quite a bit because of a Fed and because of a halving cycle. So I will get into that in this video. But I am an investor in Coinbase, and it may surprise a lot of you, I think, if I say I'm an investor in Coinbase, because their revenue growth this year is minus 58%. That's like how much they've declined this year in revenue growth. And so I really want to explain my position, and I'm going to start by explaining my position by having a premise here. So my premise is that, Coinbase, I treat my Coinbase position very much like I treat my Opendoor position. And you may know that I am bullish on Opendoor. I believe Opendoor has a lot of potential, and I believe that Coinbase also has a lot of potential. But I'm also not naive in the sense that these are very small positions for me. They are under 1% of the portfolio. And so why? Why is it such a small position? Why would anybody bother with such a small position, right? Well, it's because we have little to no visibility on revenue growth. For a company like Coinbase or for a company like Opendoor, it's just too macro. We have too little view on revenue growth for what it's going to be next year. But I don't want to be entirely out of a stock like Coinbase or Opendoor, because Coinbase has the very long-term potential, 10 years out, to be a very significant disruption force in finance and to where I believe finance is headed. Just like Opendoor, to me, has a non-zero chance of actually disrupting realtors in the United States and actually entirely turning upside down the market of how you buy a home, right? That's a $3 trillion plus market a year. Absolutely boggles the mind, whether you talk about what Coinbase could do to finance or what Opendoor could do to all realtors. It boggles the mind to think that this could happen. Absolutely does that. But it is conviction weighted, and it is under 1% of my portfolio because it's a more risky bet, because the visibility is not there. There are stocks that have just as much of a total addressable market that boggles the mind, but are very, very predictable, right? Tesla is an example, Enphase is an example, Mercado Libre in Latin America, Block and SoFi for the US. These also have tremendously huge total addressable markets. But in addition to that, they have highly predictable growth, or at least much more predictable growth, much less volatile growth. Tesla, we know the guidance of Tesla. It's roughly 50% a year for the foreseeable future. They've guided that essentially until 2030. We really know what to expect with Tesla, right? So there's less risk when you invest in a company that has a fixed guide, rather than, say, investing in a company like Coinbase or Opendoor, who is going to have no guide. And it's going to be very, very tough to figure out when that growth curve is going to kick in. So because there are stocks out there that are highly predictable and that have a huge total addressable market, my portfolio is conviction weighted. And so before recording this video, I was looking, so Tesla is about 20% of my portfolio. It's my biggest position. And actually Coinbase is 0.8% exactly. So the conviction weighting is there. And you need to reward stocks that give you predictable growth because they are inherently less risky. They're much less risky for you. But you may ask, so why do I bother? Why do I even bother with a 0.8% position? Well, I bother for it for two reasons. First of all, I do believe that Coinbase or Opendoor could be, as a great chance of being a faster horse, i.e. a quicker 10x than Tesla. Right? To me, there is little doubt that Coinbase could be a much quicker 10x than Tesla. Is Tesla a 10x? I believe Tesla is going to do a 10-bagger. I believe that. But it's going to take a decade or 7 or 8 years, right? I don't think that's true for Coinbase. I think Coinbase, the next halving cycle, you could get there. Just like Opendoor. Opendoor, if we have a Fed pivot, and if we get back to the standard state of monetary printing, Opendoor could do a 10x much faster. So that makes sense when I say it's a faster horse. It's a much faster horse to look at a company like this. So that's why I have a much tinier position, because I don't need as much of a position on these stocks to have a major effect on the portfolio. So another reason why I own a stock like Coinbase or Opendoor, and there's a few more that are under 1%, is because I want to follow these companies. These companies are major disruptors. And if I don't have a credible commitment to a company, like if I don't own their stock, I'm just not going to follow them. Or I'm just not going to put a lot of effort in following them regularly. And so following Coinbase keeps me sharp. It helps me to be at the cutting edge of fintech, and it helps me understand crypto, because I don't do much crypto. I do mostly Bitcoin, and Bitcoin is not crypto. I have a little bit of crypto, but very little. I have mostly Bitcoin. So this allows me to follow this space that I don't invest in naturally, because I'm not the demographic, right? I'm not Gen Z. I'm not that demographic that loves that space. I think that's part of the reason why. But I see a lot of value in the space. And let me just tell you about return asymmetry here. And this is important to understand this. So if I'm wrong on Coinbase or Opendoor or any of these more tiny speculative positions, a 0.8% loss, or if you have like 5 stocks like this and you're wrong on all of them, right? That's a 4% loss. It doesn't change much in the grand scheme of things. Like in your portfolio, it doesn't change much. So the downside is very limited. The downside is you lose everything. But you lose everything on 0.8% of your portfolio. So you really don't lose much. So there is a limited downside. But if you're right, there is a huge upside. If you're right, the upside could be a 10x, a 15x, if you're right. And so if I'm right, on a stock like Coinbase, Coinbase could become, 20% of a portfolio someday. Ask any early buyer of Tesla. People who just bought a little bit of Tesla back in 2014, 2015, because they saw the car on the street and they liked it. They thought it was a cool idea. They did a little research, they buy Tesla. Next thing you know, Tesla is 20% of your portfolio. How many people are like that? Why? That's because that's the nature of stocks. Stocks are, there's risk. But the risk of most stocks, most disruptive growth, newer company, not entrenched, companies with still a CEO, companies at the heart of innovation, that is upside risk. It's mostly upside risk that you have in a lot of companies. And I believe Coinbase has asymmetric risk to the upside. I believe the stock is more likely to do well than not. And if it doesn't do well, if it goes to zero, if it goes bankrupt, which in and out of itself is highly unlikely, but if it goes bankrupt, no big deal for a portfolio. So you manage your positions. You try to not have too much of a position. And the reason why I do that, I told you a slide ago, right? It's not as predictable. The growth is not as predictable. But I'm also well aware of the risks. I am well aware of the risks. And before I tell you 5 catalysts, let me tell you about 5 risks. And you're going to see a common theme. It's regulation, 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 regulation. That is the big risk for Coinbase, and I am well aware of that risk, and I am okay taking that risk. But all sorts of crypto regulation is coming at the pace of government. Government moves slow, but regulation is coming. And so I listened to the call of Coinbase. It looks like that regulation is going to be a big issue in the 2024 election in the US. The US is lagging in innovation. Actually, Europe released MiCA. Hong Kong is working on regulation. Singapore is working on regulation. The US is actually lagging on regulation here, and it's kind of a gray area with regulation. But there's a lot of lack of regulation in the US. That's going to hurt the stock to not have knowledge, right? Regulation doesn't hurt the stock. Regulation actually could tremendously help the stock. What hurts a company like Coinbase is not knowing how to handle its product, not knowing how to comply. Coinbase wants to comply. They say it all the time. CEO spends a lot of time in Washington, D.C. They want to comply, but they have very, very little guidance. And the SEC just comes and like bans something. And there's little guidance for a company like Coinbase. So they're begging for guidance. So that's the main risk. Another big risk is a cultural risk, right? Well, technological/cultural risk is the whole idea is that, SEXs, i.e. centralized exchanges, are not, at least it's this theory, that they are not really needed as the main platform because people want to use decentralized exchanges, DEXs, like for example Uniswap. So people are like, why would you trade on Coinbase when you can just trade on a DEX like Uniswap? To me, that's a minor risk to me because people are going to need a more user-friendly interface. And then B, you're always going to need that gateway to move from your scriptural bank money to your digital token money. So to me, that's less risk to USDC regulation, right? That's a big risk. If the US launches its own digital dollar or its own stable coin, USDC could be banned. Right, and if USDC is banned, that's a major risk for Coinbase. But this risk of a ban of USDC, you'll see later, needs to be put in perspective compared to the opportunity that USDC could be. Right. Another risk would be that the L1s that Coinbase offers to investors, most of these L1s could be classified as securities per the Howey test. And so if they're classified as securities, that means that Coinbase can't really offer them anymore, or they're going to have to do a lot of work to be able to offer them. And so that means fewer trading fees. And so Coinbase is working a lot on regulation to try to get them to change the Howey test so that things like digital collectibles are not considered securities, etc., etc. There's a lot of work. The CEO in the call is saying Coinbase this year, 2023, is going to be the year of regulation and working with regulators. So that's a risk. And it's a major risk. And then lastly, I believe, and this is kind of my risk, is that the short-term pressures of Wall Street are like overwhelming on Coinbase, and they have putting so much pressure that Coinbase keeps laying off people. And so how do you know you're not laying off that engineer that you really needed? For a company like Coinbase, I'm not looking for quick net income. I'm not looking for that. The company IPO'd at a very high valuation. They have cash on the balance sheet. I would prefer them see them invest. But this is an issue that I find in a lot of stocks, that Wall Street is giving short-term pressure and pushing them for the short term, and that's killing the growth thesis for a lot of these stocks. Like Palantir is another one that I'm pretty upset about, right? Where Wall Street is pushing for profitability, while really I don't think the stage right now is profitability. I don't think that's the right stage right now for companies that are high growth. So these are the risks. I'm aware of the risks. Now that I'm aware of the risks, let me show you the chart. So you can see that Coinbase is still 82% down, and that's after a big run-up. Actually, early 2023, it was 90% down. So when the stock was 90% down, if you bought it in 2023, like if you got Coinbase at like $38 or $36, I think I picked up a few shares in the high 30s. If it goes back to what it traded at as IPO, that's a 10x. Quite simple. If it goes back to the IPO level, that's a 10x. And even if today, like if someone invests at $62, if it goes back to IPO, that's a 5x. If it doubles again, that's a 10x. So this should put into perspective what I was saying earlier about the company just being a faster horse. I believe these companies, even though way riskier, have the potential to be a faster horse to jump on. So let me, however, go through the first catalyst. So I've gone through the risks. Now let's go talk about the catalyst and the ultra long-term catalyst. These catalysts, to me, everything I talk about is at least 5 years out, more likely past 2030. So let's talk about the catalysts. So the first catalyst that I see coming for Coinbase is the next halving. If you've been following crypto, you know this, and keep in mind that as far as Coinbase is concerned, Bitcoin is about 40% of a business. So we still need to keep in mind that Bitcoin is 30 to 40% of a business. So it's still huge. Like it's still the main reason why people go on Coinbase is to buy Bitcoin. So crypto is about the same size as Bitcoin in general. So the dominance is still there. And what do we know about Bitcoin now? We know that it's all linked to the halving cycle. And I want to show you this chart, which is the halving cycle of Bitcoin. So every miner, right? Every time you mine Bitcoin, every 10 minutes a new block gets mined, and whoever mined that block makes 50 Bitcoin up until 2012, and then it halved. And when it halves, you make twice as few Bitcoins, and then it halves again and you make twice as few Bitcoin, and you hit halves again, and today miners make 6.25 Bitcoin per block. But like a clock, every 4-ish years, the amount of new supply of Bitcoin is cut in half. And when that new supply of Bitcoin is cut in half, as far as history goes with Bitcoin, it always brings a wave of major excitement for Bitcoin, because all of a sudden, if you have, markets trade at the edge, Bitcoin is traded at the edge. If all of a sudden the new supply of Bitcoin is cut in half because of the halving, you're going to have a lot of excitement into the space, a lot of trading into the space. And so, knowing this, you may know when was the last halving, right? The last halving was in April of 2020. That was the last halving. And what did we have for Bitcoin? We had a year and a half of major excitement, just like it's always been. So whenever there's a halving, you have a part of the market that's called, the crypto summer or the crypto bull market, where it goes up. And you can see, going back to the beginning of Bitcoin, it goes up the first year or two after the halving. It goes up. We're about in year 2 here. And then the excitement, like all excitements, like any stock, the excitement wanes down. Nobody cares anymore. And then you have a usual narrative: crypto's dead, crypto is rat poison, crypto is really bad, crypto's going to die. And these are cycles. These are very, very common cycles for Bitcoin. And of course, right now, we are in the depth of that down cycle. And we know we're in the depth of that down cycle when we look at the numbers for Coinbase, which Coinbase is still making most of its money from transaction revenue. That's what Coinbase makes money of. They make money from transaction revenue, right? 2021, high excitement. Everybody wants to buy Bitcoin because we are in the early stage of the halving cycle, right? In the early stage of that cycle. So you have huge volume, major profit. Coinbase makes a bunch of money. 2022, nobody cares about Bitcoin anymore. Nobody trades Bitcoin anymore. And you have profits that are down 57%. And so this is a stock that is cyclical, and that is really coupled with a Bitcoin halving in its cyclicality. And the next Bitcoin halving is probably going to be like in April or May of 2024. So we are a year and 2 months. A year and 2 months is the next halving. And when the next halving happens, give it a couple months after the next halving, and you typically can expect, this is no advice of any kind for Bitcoin or for investment of any kind, no advice, but historically you've had a huge excitement whenever there's a halving. Everybody in the crypto space gets very, very excited whenever you have a cut in the supply of Bitcoin. So that's why I believe this pattern for Coinbase, this pattern is going to keep repeating itself over the years. So we don't have enough. We don't have enough. We don't have enough data to look at revenue growth for that stock. We really don't, because we would need 4 years, and we look at the data on a 4-year cycle. It's almost as if we should look at Coinbase with like a 4-year cycle length, and we should measure the revenue over 4-year periods to really measure how they're doing. And Coinbase knows that issue, and of course Wall Street being short-sighted as it is, Wall Street only caring about the next 12 months, right? There's no way Wall Street understands this. There's no way Wall Street is digging deep into this and digging into the cycles. And so you have a whole bunch of, downgrades, sell the stock's a scam, etc., etc., etc. And the CEO, right, the firm is working on this right now. They're trying to grow their subscription revenues, like their subscription to their trading data, right? A bit like Bloomberg, but for crypto and all sorts of other subscription and services revenue, which I'll get into. They're trying to grow that really, really fast to have kind of that, smooth revenue growth. They want to have a smooth revenue growth. At least that's what they're trying to do. Because a business that has smooth revenue growth will typically be, trading higher by the market. It's actually a whole field of accounting. It's called like earnings smoothing and how you can smooth earnings to give a bigger valuation of your stock. Anyways, so that's the halving cycle. And the last halving cycle, when we had the last halving cycle, it was led by tremendous adoption in the USA, absolutely tremendous adoption. And now, and this is the CEO data on the call today, we have about 50 million Americans who are active in crypto within a 1 month period, who either use it to buy, I don't know, hot dog with Dogecoin at some stadium somewhere, who trade it, people who trade it, right? Americans who trade it, who buy it to put it in a brain wallet and to just keep it for a long time, and they buy BTC and crypto. So we have active users, 50 million people. One house sold out of 5 in the USA, just that. And in the world, we have about 1 billion people that own either BTC or crypto. Gen Z and millennials, it's become obvious. If you pause the video and look at that chart, Gen Z and millennials, but especially Gen Z, prefer crypto even over stocks. They love crypto. This is what people 23 and under love. I don't know. I I like it. I like it too. I think it's a great thing. But it's I'm a stocks guy. I love stocks. But and Gen Z tends to love crypto. And so I'll ask you, what do you think? Whatever post Gen Z is going to be called, do you think it will be even crazier? And all I have to say is, have you ever heard about Robux? And then you probably know that they're going to be probably even more gung-ho about digital assets in the generation that succeeds Gen Z. And and you're investing to cater to the next generation. That's what growth investing is all about. You want to invest in the products of the future. Gen Z, millennials, and whoever comes after Gen Z is the future. So anyways, and 2023 today, I would argue, and 2022 is really, it's really the year of people trading out of platforms, and that probably hurt Coinbase a little bit too, because Coinbase, of course, has custody fees, right, to custody your Bitcoin. And so a lot of people, institutions, are just moving away from custodians right now because they don't trust those crypto banks because of what happened to FTX, what happened to Celsius, right? They went bankrupt, people lost all of their money. And so the big movement, which actually the CEO of Coinbase tells customers to do, which tells me is wonderful. CEO of Kraken does the same thing, tells customers to do, is like, buy your crypto on our platform, buy your Bitcoin on our platform, and then self-custody it in what is called a digital wallet, a digital safe. So this is Best Buy. You can go to Best Buy and buy a ledger. It's a digital wallet. And then you just turn it into a brain wallet. And so a brain wallet is simply your crypto, you store it in your brain. You memorize 12 words. And if you memorize 12 words, you can store all of your crypto by memorizing these words. And some people find this very, very helpful, especially in countries where the law is perhaps not as advanced as other nations. They think it's probably a great idea to just have your money in your head so that it can't be seized away from you. That's one of the major applications of Bitcoin, is you can just store it in your head. And crypto in general, stable coin as well, US dollar as well. So the first thing that I'll ask is, what will be the next cycle? What will it be like? in 2024, April, mid-2024, second half of 2024, when we have the next halving, what will that cycle be like? Will we move from 50 million Americans to 100 million Americans owning it? Will we move from 1 billion people around the world to 2 billion people owning it at the next halving? I don't know, but every single time we've had a halving, we've had an insane step up in the adoption of Bitcoin. You may remember the first headlines about Bitcoin reaching $1,000. And then you may remember the next headlines about Bitcoin reaching $17,000, $16,000 in 2018. And you remember certainly the headlines of 2021 with Bitcoin reaching $69,000. All of these headlines coincided with new adoption cycles. And so what does the next cycle have in store? Well, the next cycle have in store probably more than 50 million Americans. Maybe it's going to be a doubling again. I don't know. I just can't know. That's why I don't own as much of this stock, because it's not predictable. But what you can predict is that there's going to be some movement, but it's not as predictable, as a SaaS company or as a Tesla. It's just not as predictable. So let me move to catalyst number 2. So catalyst number 2, I believe, is much more universal than crypto and Bitcoin. So not everyone agrees that Bitcoin has value. So you have cynics, right? People who are anti-Bitcoin, who will say that Bitcoin is at worst dirt and at best a digital collectible, like a digital novelty worth a few dollars, because it's fun and you own a piece of internet history. You own a piece of that fad that Bitcoin is going to be. That's what cynics will say. And then you have realists, and I believe there's really consensus forming around the realists right now. Realists say, okay, well, it's a new form of gold. It's kind of like gold, but it's a new form of gold, and you really don't want to dig too deep in it and understand the supply of gold versus the supply of Bitcoin. But people are like, yeah, it's a digital gold, and it's really an idea that a lot of people go forward. People say, well, it should be worth what gold would be worth. And so they say, well, gold didn't go up as much because gold prices are manipulated, which they totally are. But Bitcoin prices are a little manipulated too, but not as much. And they say, well, look at Bitcoin. Bitcoin went up in value because Bitcoin is the next asset that's going to replace gold. And then you have optimists, and optimists tend to view Bitcoin as self-evident. And they think that infinity is going to be divided by 21 million. And if you ask me where I stand, and if you've been watching my channel, you know that I use Bitcoin as a replacement for bonds. I don't own bonds, but I own Bitcoin, and so I do kind of 100 minus my age, and then it's kind of my allocation to Bitcoin. So Bitcoin is a major position of my portfolio. Close to Tesla, essentially as big as Tesla. Anyways, my stance on this is somewhere between realist and optimist. I stand somewhere between the two. It is objectively much better than gold. So my stance on Bitcoin is actually much more bullish and much more positive than my stance on Coinbase. I am much more bullish on Bitcoin, hence conviction weighting, right? There is conviction weighting here because Coinbase is only a teeny tiny portion of the portfolio. So regardless of what one thinks of Bitcoin, though, regardless of that, there is one thing that the world's agree with, that the world's consensus agrees on. There is one thing that the world tends to agree on, is we want US dollars. Or as a more general rule, we want stable coins. We want US dollars. We want those crypto rails for the US dollars. We want to be able to move money instantly for next to nothing on digital cryptocurrency rails. That is kind of a consensus that we see right now in the world. And, a lot of people may not be comfortable, say, having a brain wallet with a bunch of Bitcoin on it, but they would totally be comfortable having a brain wallet with a bunch of US dollars on it. Enter Coinbase's own stable coin, USDC. So Coinbase owns USDC with formerly a startup, now a much bigger company called Circle. So Circle and Coinbase own 50-50 of USDC. And USDC is nothing less than the second biggest stable coin in the world, right? So if you look at the biggest cryptos out there, or crypto tokens, so you have Bitcoin, which is the king commodity, right? The digital gold, the thing that started the blockchain industry. That's Bitcoin. Then you have Ethereum, which is the first true layer 1 blockchain as we mean layer 1 today. Then you have Tether, right? Tether is the number 1 stable coin out there, USDT. Then you have Binance Smart Chain. So Binance is another layer 1 blockchain that, is sponsored by Binance and is competing directly with Ethereum and a whole bunch of different layer 1s. And then the number 5th one is what? It's USD coin, USDC. USDC is the 5th largest crypto token out there. And it's worth $42 billion, way down from the peaks in 2021. You may remember the peaks in 2021, that is way down compared to what it used to be. But let me tell you how that works, right? So you have USDC. When you own USDC, you just own USDC. It's not much, right? You own it on your wallet. You can go around. It's dollars. It's not an interest-bearing account. It's like having cash in your wallet. But look at this. Look at the revenue for Coinbase. So Coinbase, that interest income here, that 327 million, most of this comes from USDC. Most of this comes from USDC because Circle and Coinbase share interest incomes, i.e. treasuries, right? What they invest in treasuries, on $42 billion worth of cash. They get to earn interest on that cash, and that cash goes here. And that is absolutely stunning to wrap our heads around the potential that this could have. Let me ask you a question. What if the digital dollar is going to be a thing? Is it going to be a private digital dollar? Is it going to be a Fed-issued digital dollar? We don't know. That's part of the risk. But what if the Fed allows, I don't know, a US regulated company like USDC to issue a good share of the digital dollar of the future? Imagine how big could that get, because that's only $42 billion of cash out there. But, this channel is called Beat the Denominator. So if you've seen my video on macro, you probably know how much cash there is circulating out there. So how big could stable coins get? Let me tell you. M2, i.e. the money stock in the US alone, is 21 trillion. Euro dollars, i.e. the money stock outside of the US, and it's tough for me to get an estimate, but latest estimate I've seen is about $65 trillion. So there could be, and because of the euro dollar and the more hidden nature of the euro dollar, we don't know fully how many euro dollars there are out there, but there's $86 trillion out there. 86 trillion single dollar bill, if you want to make it simple. Out of those 86 trillion, how many can become digital? How many can become crypto tokens? Right? It's $42 billion right now for Coinbase. And if you add both of them, right, you're at 110 billion. If you add Tether and Coinbase, you're at 110 billion. So, what can we say about that? Right? What if USDC was just 1 trillion, right? 1 out of 86, so less than 2%. What if USDC was just under 2%, right? 1.5% of all of the money out there. What if it was just 1%? Let's just assume it's just 1%. So what would that mean? If it was $1 trillion of USDC, right? Half of that in T-bills right now would equal $22.5 billion of nearly pure profit. Because that's near, sure, there's a little bit of, you got to pay the fees of Ethereum because you run this on Ethereum, and there's a few expenses. But as far as we're concerned, it's you have some rewards, etc. that you pay. But as far as we're concerned, this is mostly pure profit. So if Coinbase had $1 trillion USDC and it was operating USDC and it was earning money on all of that cash, right? You could just think about $22 billion. $22 billion here, right? Try to substitute that with $22 billion. So again, and this company's market cap right now is $15 is 14 billion is the market cap of this company right now. So I understand we have to do a little bit of math gymnastics to get there. But if digital dollars are going to be a thing, and if USDC is going to be part of a digital dollar future, there's one company that's going to benefit tremendously, and it is Coinbase. Because Coinbase is running that network, right? Coinbase is behind USDC, 50% of it. So that's catalyst number 2. And the question you have to ask yourself is not only A, adoption of Bitcoin, that's going to help Coinbase, catalyst, and B, adoption of digital US dollar. That's a catalyst that's going to greatly help Coinbase. Let me move to catalyst number 3. And catalyst number 3 is, quite sad, but because FTX went down, because so many other companies went down, Celsius, Voyager, I could go on, there's a few more. Because they all went down, Coinbase is kind of the last company standing. It's like the last gateway standing. So Coinbase can be thought of as really a tax on the transition of the crypto world. And then a tax on the crypto world itself. So, individuals and institutions go to Coinbase and they do their Know Your Customers and AML. Coinbase, is all about compliance. So they do all of their compliance duties. And then you go from Bank A, Bank B, Bank C, and you transfer your scriptural USD into digital USD, right? And once you have it transferred into digital USD, you have the Coinbase card today, so you can spend your digital USD with a debit card that Coinbase issues, and there's no issue. It just debits your USDC and you spend it with your card. You can do that, but you can also trade 150 different crypto assets on Coinbase, invest, buy, right? You can bank with Coinbase. If you don't feel confident having your own brain wallet, you think you're going to lose the code or something, you don't feel confident with the tech, you can have Coinbase hold your crypto for you, in which case Coinbase is going to make some money on that crypto that you hold on their bank account, just like any bank, right? If you own Coinbase, you have access to so many different ventures. You have access to staking, stablecoin. You could use Coinbase as a custodian if you're an institution. So Coinbase is kind of this cloud with tons of different activities that cater to this transition to Bitcoin and cryptocurrency that they are promoting, right? And that really a lot of the Gen Z that I discussed earlier are going towards, right? And a lot of Americans, 50 million Americans. Again, ask yourself, how many people is it going to be at the next halving? It's 50 million now. How many people in the US next halving? Is it going to be 100 million? Again, and to show you, as a sign of triumph, to show you how Coinbase is really seen highly by people in that space is BlackRock, right? Coinbase was selected by BlackRock to help clients that use Aladdin, which is the main platform used by hedge funds, to allow them to access crypto trading and custody via Coinbase Prime. So this is a major deal. That means that people who use Aladdin through BlackRock, and BlackRock is about $10 trillion of assets under management. Through Aladdin, which is the main BlackRock app, you're going to have access to Coinbase trading and Coinbase custody. So the asset under management, a share of those assets under management, if they flow towards crypto, be it in the form of trading or in the form of investing, that's going to be custodied by Coinbase. So this is like a major vote of confidence on Coinbase as a custodian. Major vote of confidence. They partner with the largest asset manager in the world. All right. Let me move on to catalyst number 4. Coinbase is one of the largest validator of blockchains in the world. And if you're in the Bitcoin space, you know that a lot of people criticize Coinbase for being so powerful and so almighty when it comes to validating L1s and L1 blockchains. That's this part, right? The blockchain rewards right here. That's what we're talking about. We're talking about mostly about staking. Most layer 1 blockchains today are proof of stake. And, let me just do a little history about that. If you know anything about cryptocurrencies in general, you know that Bitcoin is a proof of work. So proof of work, when you have a proof of work blockchain, that means it's miners. Miners run the network, the blockchain. The blockchain is run by miners. That's Bitcoin. So anybody can run the Bitcoin network. You just buy a miner, you plug it in, you power it, and you run the Bitcoin network. Anybody can write transactions on the Bitcoin network. Anybody can own a ledger of a Bitcoin network. That is proof of work. Proof of work is the ultimate commodity. It's really a show of strength to the SEC and to all of the regulators that yes, it's actually a commodity. You have to mine it, just like you mine gold. You have to go mine your own Bitcoin. So I'm actually pretty happy that a lot of the L1 blockchains are moving to proof of stake, because that leaves only one contender for the future of money, or at least for the hardest commodity out there, which would be harder than gold, which would be Bitcoin. So I think this is bullish. This is very bullish for Bitcoin. I believe that most layer ones are moving to proof of stake, proof of stake. But while miners run BTC, right? Bitcoin is run by miners. It's validators who run layer ones, like Ethereum. Ethereum is a layer one, and it's run by validators. And if you are in the crypto space, you are probably well aware about this. You're probably well aware about this if you're in the crypto space. But who's one of the largest validators in the world of blockchain? I.e., who runs the blockchain in the background? As I had in my yellow text here, who is the AWS of blockchain and running blockchain and blockchain cloud? Who's the number one blockchain cloud running the blockchains? Well, I am pleased to inform you as a Coinbase shareholder that it is Coinbase. So Lido is kind of a special situation. It's a bunch of different entities that got into Lido. So I just want to say that Lido is a little bit, one needs to put it aside as well as unlabeled. If you look at single entities running Ethereum, it's Coinbase. Coinbase is the number one single entity running Ethereum, almost 3 times as much as its number one competitor Binance. Almost 3 times as much, almost twice as much as Kraken, which is the main US leader. So Coinbase has a leading position in running Ethereum. And you may say, do we care, right? Do we really care that Coinbase is running Ethereum? Well, yeah, we care about it a lot, because if Coinbase is running Ethereum and validating Ethereum, this is your staking rewards, right? Staking means that, miners, when you mine a Bitcoin block, you get 6.25 Bitcoins. Well, staking works a little differently. When you stake Ethereum, you earn the new supply. The new supply of Ethereum goes to you, and it's those transaction fees that flow to you to validate the network. So actually, Coinbase is earning 4.27% on its Ethereum in the form of Ethereum by being a validator. And so that's a major sum of money, as we saw more than $200 million, as we saw in the former slide, $275 million for these blockchain rewards, right? And these are really likely to grow going forward. But look, it's not. Look up. Go on stakingrewards.com, and you can look up validators for a whole bunch of layer one. Pick your favorite layer one. I tried to look at some of the layer ones that I know of more or less. The hottest layer one right now is in my view, it's probably Solana. Like a lot of people are saying Solana is going to be the next big thing, better than Ethereum, etc. I don't follow that space too much, but I know that Solana is a very, very hot blockchain. And who's the number one validator in Solana? You guessed it. It's Coinbase Cloud. It's the number one validator in Solana. And I took a much smaller layer one, but a layer one nonetheless, which is Tezos. And who is the number one validator for Tezos? You get it. It's Coinbase again. It's Coinbase custody again. And Coinbase is once again bigger than Binance, bigger than Kraken. So Coinbase, as it hands, as it stands, in running almost all of the blockchains, which is absolutely fascinating. So that is, I believe, going to be a major catalyst for the next decade. We don't know which L1 is going to take over and win. Is it going to be Ethereum? Is it going to be Solana? We really don't know. But if you want to make a bet, you can bet that Coinbase is likely going to be supporting it in the background. So this company has really its hands in just about everything. And the last catalyst, and I'll finish with this, is that if the move to crypto is as big as proponents of crypto tell us today, which, again, it's a risky stock. It's 0.08% of my portfolio. I believe in Bitcoin. I'm highly confident in Bitcoin. Crypto, and Coinbase is mostly a crypto play. Yes, they make money trading Bitcoin, but it's mostly a crypto play. Crypto, it's still a cloud in the distance. It's not as certain, even though I tend to believe that crypto is going to be a big part of the future. If crypto is a major part of our future past 2030, you could have a company that's as big as, say, a BlackRock, a JP Morgan, a Visa, MasterCard, an Intercontinental Exchange, New York Stock Exchange, NASDAQ, Bloomberg, and A16Z of today, if the world of finance moves to blockchain rails. So the sheer size of the legacy institutions that it could substitute is just absolutely staggering. Like, if we are all moving on crypto rails, and keep in mind, it doesn't matter which fancy app you use, right? You can use SoFi to do crypto. You can use blockchain to do crypto. But, in fact, most people don't realize what's going on in the back end. When you use a New York Stock Exchange or Intercontinental Exchange, you don't realize what's going on in the background, right? Most people in their 401ks don't realize that BlackRock is the one underlying it. But if crypto is going to underlie the next generation finance, and we're talking beyond neobanks, beyond fintechs, if beyond that crypto is going to be the layer on which this is built, then Coinbase has the potential to be as big as all of this. So the sheer size is huge. And just food for thought. Let me tell you some more food for thought of a call. I listened to the whole call today. Absolutely fascinating. Yesterday. Absolutely fascinating, the call. On the call, he's asked, about tokenized stocks. Trading stocks 24/7 as token is part of the long-term plan. It's entirely possible that companies that do IPOs 10 years from now decide to issue a security in the form of a token. There's actually nothing that prevents it. Today we talk about shares, and we call these shares, and they're managed by our legacy financial institutions. But there's no reason that these shares have to be issued in the form of a scriptural mark on an exchange, like computer share. Like it doesn't need to be traded through computer share, right? A share of a stock can be like a legacy stock. Actually, you can buy those as legacy items. You can buy an actual stock with your name on it, and most people don't do that. Most people own stock in street name, i.e., under the name of computer share or your broker. But nothing prevents you to have a stock that can be in the form of a token and traded in the form of a token, and then go back to what I was telling you about the brain wallets, unseizable, all that good stuff, self-custody. Then you could self-custody your stocks. This is part of a long-term plan of having stocks trade 24/7. When we really think about it, there is no reason for stocks not to trade 24/7 with today's technology, right? It's the fact that stocks trade 5 days a week is an artifact of the past. It's an artifact of the past because you actually needed people to argue on a trading floor and yell at each other on a trading floor. That's an artifact of the past. We really don't need this anymore, and that would allow a lot of routing of trades and shadow trades and payment for order flow if you had a transparent stock of companies trading on the blockchain, that would solve a lot of issues. This is part of the plan of Coinbase. So this is part of their plan. I just thought it was good to know that this was a plan, and Coinbase, it's got its hands in so much that it could really be tremendous. Coinbase has a central role in what? It's got a central role in running layer 1 blockchain. So not Bitcoin, right? Bitcoin is different. Bitcoin is operated by miners all around the world. But it has the potential of running, things like a good share of Ethereum, a good share of Solana, a good share of all of the major blockchains out there. It has a good chance of running it. It has a good chance of being one of the top players in the transition from scriptural money, i.e. the bank writing on its own ledger that you have money with them, right, to a blockchain-based US dollar. They are at the forefront of this technology, Again, I don't know if they're going to win. I mean, the Fed could shut it down, but the present value right now, knowing that it hasn't been shut down, that present value is positive and is likely high. It's risky, but it's not a zero present value as long as we don't know that this is going to be a thing or not, right? They have an impressive VC arm with a hand in just about everything. They have a relationship with several Fortune 100 companies, including Nike, including Starbucks, to develop NFTs, collectibles, the ticketing of the future, right? Part of the whole Web3 movement is that you can have a Web3 wallet and say you want to go to, I don't know, a basketball game. Well, your basketball game is an NFT, and so it's just transferred to your wallet as an NFT, and then you have a memento of your experience that you can potentially resell. That's the whole idea of these non-fungible tokens or these tickets, such that imagine if you had been, say, in Woodstock, you had been to the Woodstock concert in the 60s and you had the digital ticket for this. The whole idea is that ticket probably would have a lot of value as a collectible, right? Experiences, you could monetize so much. So there's a lot of innovations that, the next wave of the internet is having in store for us that we don't know about yet. And so when you touch a company like Coinbase, you have your hands in some of these innovations, many of them fads, some of them not fads, right? And they have an eye on other things like Web3, including wallet-based identity, where you log in with your MetaMask wallet, or you log in with a Coinbase wallet. Even you would log in with your blockchain-based identity, right? So they aim at looking at logins. They aim looking at different blockchains of the internet, running entire organizations on blockchains, including, and this is the big talk in crypto right now, including a decentralized social media. And could you create a powerful decentralized social media that is just a blockchain, not a company, a blockchain running the service, and so anyways, again, speculative company, position sizing has to be consistent, I believe, with the risk that I see in Coinbase. There are very, very, very real risks in Coinbase, but there's also a very, very real upside potential in Coinbase. That's why I own less than 1% in the portfolio. But if I'm right, and if Coinbase becomes a thing, that can have, an altering effect on the portfolio that can tremendously impact the portfolio. So that's why I am bullish on Coinbase, but of course not as bullish as more predictable companies. This company has a lot of risks, and I've highlighted them at the beginning of the video. So sorry for rambling. I am done with the video. This is not investment advice. This is just entertainment. Thank you for watching. Thanks for your support. Thanks for liking. Thanks for subscribing. And have a wonderful day. Really hope you enjoyed this video. Thank you.